Hello again, everyone. This is Mike Paulenoff, mptrader.com, with your weekly video chart update, April 18th, 2010. Alright, today we'll look at a few of the financials to see or to analyze the chart structures after Friday's major downside reversal in Goldman Sachs and other related financials. Apart from whether or not Goldman Sachs is innocent or guilty of the charges levied by the SEC, the indelible impression left on by Friday afternoon's trading is that Goldman Sachs stock ended something on the upside and started what could be a fairly dramatic decline. All right, what we see on the screen is Goldman Sachs from a weekly chart basis. You can see it goes back to pretty much to 2003. You can see the peak at 250 and change in October of 2007. The bear market that took the entire market with it, but in particular led by the financials. Goldman got down to 47.41 in November of 2008. And since November of 2008, the stock price has been able to recover about 2/3 of its losses until Friday. Goldman hit a new high for the post January-February lows at 186.41 and plunged after the midday allegations by the SEC were announced. Now, the stock went from 186.41 to 155.55, and although this is a weekly chart and this is a weekly spike, this entire move occurred on Friday. This is a major, massive one-day reversal in Goldman Sachs. So, as far as I'm concerned, the rally from January to April is complete. It's over. Goldman broke key support along the January-April trend line at about 169.5, 170, and continued lower and closed below its near-term uptrend line. What next? Well, this is a major one-day reversal in Goldman and a weekly reversal in Goldman. Let's see if Goldman, if the uptrend, depending on how we draw it, survived on Friday's decline. Now, if we choose to take most of the points along the line from November 2008 to present, then Goldman broke its trend line at about, I would say, 263, 264 on Friday, closed below it, and that trend line is broken. If we take a more traditional approach, but by just connecting the lows, we would take the November 2008 low and the January 2009 low, and that trend line comes in at 140.5 or so. From a different perspective, so in other words, Goldman has further to go before it does more significant technical damage if we choose to look at the lower trend line. However, this is how I look at Goldman at this point. I see Goldman as being a double top now. That is to say, a double top October 2009, 190 and change, 193.60, and April 2010 at 186.41. The pressure of this double top has sent Goldman down so far, and will test the pullback low in January at 147.81. If Goldman does not hold, if prices do not hold the January low, Goldman in effect will be considered, in my judgment, a massive double top formation, where the second high was lower than the original high. All of this action, months of this action, July of 2009 to April, May of 2010, an entire year of topping action will be evident on the chart. distribution of Goldman in a recovery rally scenario. Goldman breaks and sustains below 147.81. The measured objective is to about 110 to 100 in Goldman thereafter. So, right now, as I see Goldman, rally potential 168, 170 maximum. Support on downside continuation 153 to 147.80. A break of 147.80, I would be looking for a $40 decline in Goldman. So this is a very significant situation in Goldman Sachs, and it could have far-reaching implications for the XLF and the financial sector in general. While we're talking about the financial sector, let's go over and take a look at the XLF. Now, this is a weekly chart of the XLF. All right, so let's zoom in on it. And it too, the XLF, the financial spider, weekly had a weekly downside reversal. Not a key reversal, but a weekly downside reversal. That is to say, it looks to me as though the up move last week peaked at 1712. It closed at 1636, suggesting that the XLF has peaked and is starting a correction. Now, unlike Goldman, the XLF is in generally healthier condition. The trend line from March 2009 that cuts through in February 2010 crosses the x-axis, the price axis, at roughly $15. So it looks like if the XLF has more downside to go, it will test $15. And that's exactly what I think should happen to the XLF. It should test this trend line. If this trend line breaks, then I think it will follow the path of Goldman and test its January pullback lows. And for the XLF, it will be 1351. Let's go over to Bank America. Now, these are all on a weekly basis. I'm doing that for a reason, because Goldman had such a dramatic downside reversal on a weekly basis. Here's Bank of America. It too resembles more the XLF than it does Goldman Sachs, but it too had a downside weekly reversal. Not a key reversal, but a downside reversal. The peak for the entire move off the January 09 high occurred last week, Friday morning after earnings, 1986, and it closed the week at 1841. To test the trend line from January 09, Bank of America will have to press towards 1620, which is exactly what I think will happen with Bank of America. How about Citigroup? Now, Citigroup performed the poorest of all the financials. On a percentage basis, it rallied strongly, but you can see the chart pattern is quite different. All the other charts we looked at, this particular high in this time frame exceeded the prior highs, not in Citigroup. So Citigroup basically had its peak at 546, 543 in August of 09, a secondary high last week at 507, and let's see, did it reverse? It closed the week before last at 455, and it closed at 456 this week. So interesting to note that purely from a technical perspective, Citigroup did not have a weekly reversal. Could it and should it continue lower? My suspicion is, based on the chart structure, is yes, and it should test this trend line at 417, 420. Should it hold, chances are Citigroup will be a buy. It will be a buy. If it breaks, then Citigroup will test its major trend line at 344. Let's go over to Morgan Stanley. Now, Morgan Stanley had a significant reversal this week